Welcome, everybody, to the ARMOR Report. Today is Fed Announcement Day, June 19th. This is a live stream you'll find on our playlist, Investing for Beginners. This is Investing for Beginners. Those of you who are using, apps like Robinhood or whatnot, and they're just starting to put capital to work. Those of you who are opening, discount brokerage accounts and trying to figure out how to manage capital, I'm trying to put together a list of streams for you dealing with different topics and kind of breaking it down for you in short videos. And so that's what this is going to be today. Our other playlists focused on cannabis investing. You can find that on our YouTube channel, and also more sophisticated algorithmic investing strategies. But for today, I want to just break down for you a basic tool I use to manage risk on my trading desk. This is a live trading desk. I have computer screens all around me. You're kind of getting a live look into how I run capital. And so I may get distracted. Phone may ring. You'll have to bear with me. But I'm going to try to keep this brief today. I just want to share with you, I was last night a speaker at an investment conference for cannabis investing, or not a conference, more like an evening, an investing evening. And one of the questions I got from the audience was exactly the discussion I'm going to have with you today. It was kind of interesting. I've slated to have this conversation with you guys for the last couple of days. And then a question from the audience last night literally centered around this issue. So what I want to share with you is a technique I call trading around the core. And you hear me say this in other videos. Maybe it's confusing. So let me just, lay it out chapter and verse for you. There are those of you, probably you've all heard this. A lot of people like to tell you, buy and hold your portfolio because the markets always go up. You probably have heard that. Unfortunately, they teach that ridiculousness at university. They make you read books like Random Walk Down Wall Street, and they try to tell you can't outperform the market, so just buy the indexes, and over time markets go up. But that doesn't really help people. I've been doing this 30 years, working with individual investors, and I can say with a fair amount of certainty, there aren't more than 10% of the investing population, and that number is probably high, probably less than 10%, that can suffer a big sell-off in the equity market and not sell right at the low. And I went through 2008, I witnessed it. Everybody who started putting money to work in 2006 and 2007 and followed the philosophy that I could just buy and hold, I'll be okay, they ran into a brick wall in 2008, and it took them a decade to break even. And nobody wants to be in that situation. So I try to take a more active approach to managing my risk. And I call it trading around the core. I identify a company that I want to own. I identify a market environment that I think is conducive to putting capital to work. What I mean by that is every decision I make before I click the button on a new investment is I ask myself, am I on the right side of probability and statistics? And is the reward worth the risk? And if I get yeses to those answers, then I put capital to work. I will put on a core position. I just use as an example. Maybe 2.5% of my portfolio will be the core position in this new investment. But I might put 10% of my portfolio in that new investment at the right entry point. So when the probabilities are in my favor and the reward's worth the risk, I might put a 10% position on, recognizing that 2.5% or a quarter of that position is my core that I want to try to hold long term. I generally employ the philosophy that I want to buy weakness. Okay, so generally I'm putting capital to work after a sell-off, either in the market or in the asset. I put my position on. When there's strength, whether the market gets us that stock to go up, or our investment, has a great earnings announcement and the stock jumps 50%, just pulling that number out of a hat, could be less, could be more. Then what I'll do is I will sell the excess off and reduce my position back to the core. So I buy a big position on weakness. And as it rallies, I sell a piece into the strength. And I hold that 2.5% core over multiple years and multiple cycles and multiple volatility moves. And the reason I do this is to help smooth out the emotion of investing. Nothing feels worse than putting a position on, having it jump 50%, only to retrace the entire move back to where you bought it. And you sit around 6 months later saying, what the heck just happened to me? I thought I was making a lot of money and I gave it all away. That's a disaster. And so what compounds the disaster at that point is that you then sell the asset thinking you're wrong about your investment, when really it's just the market. It could just be the market. The market could have collapsed and your asset comes back to where you bought it. And you think your investment idea is wrong. So you sell it. You say, gee, I can't lose money on this. I had a big gain. Now it's back to break even. I'm out. Then the whole thing reverses and skyrockets, leaving you behind like Wile E. Coyote staring at the Roadrunner. And you're saying, what just happened? How did I miss this great idea? I knew it was a great idea and I got out of too much of it. So what I do is I trade around that core. And under that scenario, when it rallies up, I'm going to reduce my position to the core. When it comes all the way back down to break even on that core, I'm not emotional about it. I made money. In fact, if anything, I'm excited about it. I say, great, it's right back down to where I want to own it, and I can re-up that position. And I'll do that multiple times over the life cycle of an investment. So one question you asked me is, well, if you have 4 times the position size on at entry and it goes down, what do you do? Well, I always use stop losses. Okay, I'm willing to take more risk at the beginning of an investment, because what I'm doing is buying weakness and using algorithms to determine when my probabilities are right. When the statistical probability tells me I have a better chance of making money here than losing it, I'll put the money to work. But I always use stop losses on that whole position. This is important, okay? I don't hold that core. If I put a position on and it breaks down, hits a stop, I'm out of everything, and I wait for my next opportunity, then I'll re-up. And once I get it and the asset starts to run, then I start trading around the core. Does that make sense? My initial position always has a stop. And when it hits the stop, I'm out. And I have to reassess my investment process. But if the position takes off, then I start trading around the core to insulate myself against emotions. Fear and greed are the worst emotions when it comes to investing. And this is one way to reduce those issues. I hope this has been helpful today. Try trading around the core yourself as a way to manage your risk. And you could do it in any fashion. Try it on paper first. Paper trading is a great way for a beginner to see what the results would be and what the feelings are when you're managing your own assets. Okay? Take care, guys. I'll talk to you all tomorrow. If you enjoyed this live stream, please let me know. Comment, click a like. That always helps me. Comment, ask me questions, and we can address other issues in our live streams for investing for beginners. All right? Take care.